I would start by saying that we think the risk reward is as attractive as I've seen it over the last 12 years, in that the banks today are trading near 2008 valuation levels. The super regional banks are trading at 92% of tangible book. Our broader universe of banks, we focus on the bottom 500, and then the small mid-cap banks are trading at 95% of tangible book. And the banks have not been this cheap since 2008. The other attractive aspect of the banks is dividends. And now who knows if the dividends are going to be sustainable, and I'll talk about that a little later. But the super regional banks, as of last night, were yielding 6%. Our smaller banks are yielding 3.4%. And again, these dividends, if one simply looks at the a capital test, or do you have sufficient capital to support the dividends? The answer is yes. But the Fed did change the rules a little at following their stress test, and they introduced an earnings test, which most banks did pass. What differentiates banks this cycle versus last is the amount of capital they have entering it. And the super regional banks have, we look at a ratio called Common Equity Tier 1. The super regional banks are at 9.4%. In 2008, they were at 6.1%. So that's a huge difference in capital entering the downturn. And then when you look at our broader universe of banks, the smaller banks have always been better capitalized. And those banks are sitting on 12% Common Equity Tier 1 capital versus 10% in 2008. Unlike in 2008, 2009, when the big banks had to recapitalize, issue common equity at discounts to tangible book, and that resulted in significant dilution to shareholders. We don't see that scenario happening. So the market is discounting significant credit risk, and some of that is warranted because this is an economic downturn like we've never seen before. We are going to see higher charge-offs. We've yet to see that materialize yet. However, banks have been building their loan loss reserves in anticipation of higher charge-offs. The second issue is margin pressure, as I alluded to before. The Fed, in an effort to stimulate the economy, reduced rates by 150 basis points in March, and clearly that was the appropriate thing to do because that has actually helped stabilize the capital markets, and that's what's helped these the unemployment numbers recover, helps the capital markets function more smoothly. But the ramification of that is the bank's core profitability will be hurt. And in 2021, we expect banks to begin engaging in mergers and acquisition activity to reduce some of the excess capacity that exists in the industry. The third risk I would have to say is dividends, because the Fed, for the first time, has mandated a second stress test in 2020. But for the most part, the smaller banks have so much excess capital, they should be fine. But the larger banks, you could see some dividend reductions in the second half of the year. And then I would say the other risk, we have an election coming up, and Joe Biden has already said if he wins, he's going to raise corporate tax rates. And I think that's a negative for all companies because that hits the bottom line. Big part of our strategy is focused on identifying likely sellers because that's the most inefficiently priced segment of the banking market is these smaller microcap banks with market caps less than 250 million. Now, we believe in 2020, the M&A is pretty much dead. in large part because there's so much uncertainty surrounding the quality of the target's balance sheet, and the buyers really need to better understand their balance sheet risk profile. So we think banks in general are going to be very conservative. Having said that, one of our banks did do a merger of equals last week. These were two banks, and one was in New Jersey on Long Island. One was on Long Island, and one was in New York, and they did a merger of equals, and this was in our event-driven fund. So that tells you that the banks are thinking strategically. They're talking to one another, and they're looking for deals. But we think 2021 will be a year, if the economy improves as the consensus economic outlook expects, you will see robust deal activity, in large part in response to the pressure on profitability, because net interest margins will be lower in 2021 versus 2020, or they may not be lower, but they aren't going to be going up. The banks are going to need to consolidate. The smaller banks generally don't have as much exposure to consumer lending, because their biggest exposure is commercial real estate, and their consumer exposure is largely residential mortgage. And we feel good about that. But when you look at the other consumer asset classes, indirect automobile lending, because we know, consumers will default there, that business is largely dominated by the larger banks. Credit card lending is the larger banks. So the small banks, their consumer risk would be residential mortgage and home equity, and very few of them are in the indirect automobile business. So the small banks are actually going to be better suited to absorb higher consumer losses. The emergence of these non-bank lenders, particularly in leverage lending and lending to private equity companies, that has reduced some of the risk from the banking system, because those companies have grown aggressively. And now banks do lend to some of these non-bank lenders as well, and the bigger banks do. But some of the balance sheet risk is clearly less due to the fact that these non-bank lenders, they typically have a higher risk appetite than the bigger banks, and they've been aggressive the last 5 to 7 years. And so that's a very good point, that the banks, some of the risk that they normally would have taken has been assumed by other lenders. And that should ultimately, we hope, be reflected in lower charge-offs within their commercial loan portfolios. They've all talked about how their customers have adopted the use of online banking is something that has been utilized more often in this current environment by their customers. And what it's led to is the realization that they are going to be cutting branches. And we saw some National Bank Holdings, one of our holdings, they talked about reducing their branch footprint. So I think that this experience is going to lead banks to accelerate that process of reducing the branch footprint. And because they've been able to function quite well in an environment where the branches have not been used as or at least going inside the branch has not been used to facilitate transactions. So yes, so we think the banks are going to be reducing costs, and as a result of this adaptation of technology by their customers, and it's going to start within the branch footprint.